Welcome back, everyone, to Vox Markets. My name is Paul Hill. I'm delighted today to be able to speak to Roche of Schroders, one of the UK's finest mid-cap investors. So welcome, Jean.
Thank you very much. Lovely to be here.
Yeah, well, we've had a nice little rally, actually, on the markets in January so far, largely on the back of declining inflation expectations, a lower dollar and falling bond yields. But the sort of $64 million question now is the rally sustainable, or is it another one of those sort of disappointing head fakes we got so often last year?
Yeah, well, we're all here to find out the answer this year, aren't we? And no matter what we say today, one thing I tell you, it's obviously, what I do know is it's going to be wrong. So starting with that, I mean, the good news, I think, really is that the market's performance is unlikely to mirror that of the global economy. I think we'd probably agree on that.
Yeah.
The market's not equal to economies. And at the same time, wanting to have my cake and eat it, much of the bad news is already priced in, I think, in terms of, and particularly so in the market in which I'm most interested in the UK. But we've had, as you know, multiple supply shocks and the inflation that follows from that. And now it's, as you started with, the fact that inflation expectations are starting to come down. So you have the expectations coming down, not just the inflation coming down. So those two things tending to be very good for particularly UK mid-caps, as it turns out.
Yeah. This sort of like nirvana that people are hoping for, of a sort of like a soft landing. I mean, is the plane going to get anywhere near the airport, or is it going to sort of overshoot? I mean, it just seems as though if the Fed and the central banks do hold rates for a long time, then there's going to be that lag effect where it damages the economy. It may have already done so. And on that basis, then, we're going to see higher unemployment. And I know the stock market and GDP are not in sync. There's a time lag between the two. But if we do see a downturn, what's your view? Are we going to get a soft landing, or is that sort of like off the cards?
Well, I think, I've seen this referred to the current situation as a, job full recession. And actually the official definition, according to our economists, they very helpfully do a call every Monday morning for us, sort of running around the world in 45 minutes, which is brilliant. And, they talk about the fact that, officially for a recession, you need to have people losing jobs. And I think, we're seeing, for example, in the UK, net jobs being created every month currently. And if we look also, the other thing about a recession is we don't know till afterwards either. So it's this is the tricky part about it, but it is looking like the job situation is still very strong. And while some sectors are more affected than others in terms of some job losses, net, we are still seeing jobs being created in the UK, which I thought was very interesting. And, obviously surveys differ, and but, in the survey that I'm looking at, it's showing job creation, and that's an ONS survey.
Okay. And when you put that, marry that together with the sort of the valuation reset, particularly in the UK, which I think is a lot cheaper than sort of international market, just talk us through of what you're sort of like seeing in terms of sort of the attractiveness of sort of UK mid caps compared to other asset classes.
Well, I think first of all, the first thing to say really is just UK in general. When we look at our, you can call it box and whisker graph, or candle and the candlestick graph, whatever you want to call it. Yeah. The UK is looking very sad, right down at the bottom, outside its historic range. And that's if you look at all of the UK market, but also the smaller mid caps as well. So looking attractive from a valuation perspective relative to its own history and also relative to the world. So I think that means people are now feeling they probably can't ignore it anymore. And I think I'm seeing a bit more FOMO coming in.
Okay.
In caps. And I think certainly some stocks did get too expensive. We've seen some of the, stock market darlings last year got derated by up to 40%. They didn't have downgrades. They kept their darling status in that they didn't disappoint in terms of earnings, but it was just the price people were willing to pay for those earnings. And to kind of believe that that growth could continue, that belief started to wane, it seemed. But the appetite for that, it feels like, has come back now. And some of the doubt seems to have gone away. I think I mentioned at the beginning as well, the fact that inflation expectations have begun to come down seems to be having a direct knock-on effect on willingness to now buy those, to buy those mid caps which have derated quite in quite a chunky way, certainly for some individual names. And as a stock picker, then you want to pick the ones that have derated the most. So I think there's some bargains to be had relative to a year ago.
Yeah, we'll come on to those individual names. Yeah. In terms of more broad picture in just of the M&A scene, given that we've got less bond volatility, which was largely, we shot ourselves in the foot in September, is it likely that we're going to get sort of like a pickup in overseas buyers looking at the best quality assets in the mid-cap sector?
Well, that seems very likely. We've been short on marginal buyers, haven't we, in the UK? So helpfully, we've had private equity, we've had trade buyers, we've had the management of companies themselves and the companies themselves stepping in to pick up the shares. Where we won't. But on M&A specifically, you've had out of the blocks already. You've had 2 bids, one that have been announced since the start of the month. That was Dignity and Standard Chartered. So I think, and Dignity have already negotiated themselves a higher price, helped by shareholders, no doubt. And the Standard Chartered not happening for now, but revealed that they were being looked at. And I think you had some premia as well, which were really eye gouging last year. So you're looking at sort of 80, 90, 100% premia. The likes of Micro Focus, Brew and Dolphin. You also had Meggitt, and some and RPS Group. So you had a lot of very significant premia. So you did have some deratings, but good healthy premia then as a result. But that's not what we want to cheer on. We want people to be buying the shares and long term making the most of those. We can talk about this a bit later if you like. What we're seeing is many 10 baggers and 30 baggers, which we've been doing some work on here at Schroders Towers, where there are more of those in the UK than there are in the US as a proportion of the overall investable pool.
Oh, really? I didn't realise that. Yeah, we'll talk about that perhaps maybe a bit later. Now, just moving on to sort of like an area that has been really resilient, particularly over the last year, in fact, done very well, is sort of defence and cyber. And one company that's been a perennial sort of like M&A target is Chemring, because I think it makes sort of like world-class sort of like helicopter aircraft flares and decoys, and obviously that's been useful given this environment. And then there's got a sort of like a high sort of like cyber security stroke electronic warfare division in there called Roche, I think. Do you want to take us through how you see sort of like Chemring, because it's still relatively good value actually?
Yeah, I mean, sort of mid-teens P and yielding, about 3%. It's, I think the bit that people are most excited about is the Roche Manor business, which, as you said, works on cyber warfare, or what we call the grey zone. And that is about 25% of group revenues now, growing at a double-digit lick. And they're looking at doubling the size of that business. It works very closely with the intelligence services. And tends to actually hire quite a lot of intelligence services staff as well, and so that is the very exciting part of that business. It also has a balance sheet which is fit for doing maybe some bolt-on deals, and they have done a little bit of that. So I think they're at a place where they can add more in that division, and I certainly think that's something that they will look to do. But more generally, what's exciting I think for defence is the clue was always in the name. It was sort of seen as a tack maybe 15 months ago, and then I think there's been a bit of a renaissance or a change in attitude towards holding these stocks, and we always saw them as inexpensive tech stocks, this sector.
Yeah, you're right. World class. I mean, if that'd be the classic sort of US military deciding to to basically pick some of the really sort of world class beaten down or so we say good value names. I mean, one thing would strike me with Chemring, is there an unbundling opportunity there? Because I mean, if you put only just a mild sort of 5 times sales multiple on Roche, you get nearly all the market cap of Chemring as it is. So you get the rest of the defence business, which is pretty successful, for free. Yeah,
well, I think certainly some market commentators think that that's a possibility. I mean, you would have certain, government players who may be, feeling a little bit nervous about that as well. So, but I think, the fact that this turbocharges the growth of the group overall is an interesting one. And, certainly you could see a world where you hive the businesses off from each other and realize value that way. But, I think that sector is always interesting from point of view of government being very interested in it as well. And, that's kind of a push-pull in terms of how they can be valued.
Okay. And then another one in that sector, which has done really well, is Qinetiq, which is sort of like more of a R&D services, but again, sort of like in all kind of robotics and in cyber warfare and stuff like that. And I think it's just made an acquisition actually as well, hasn't it?
Yes, it's made an acquisition in the US. And I remember first looking at Qinetiq and saying to them, what I'd really like would be if maybe half your revenue is coming from the US, because that's the exciting, that is the big daddy of defense markets.
Yeah.
Or the big parent.
No, you're right. Yeah, it is. It's by far and away the world's biggest defense market, isn't it? The US.
Yeah. I mean, it really dwarfs the others. So I think for them to be, because the criticism in the past was always, well, your only customer really is the UK Ministry of Defence, responsible for 80% of revenues. And now with the more recent acquisition, on top of other acquisitions they've done in the US, they're looking at moving to 50% revenues from that market.
Wow.
And, it's, as I say, getting access to those deeper pockets. So it is an exciting time for them. And they've been able to grow the top line at a double-digit rate and able to do teens margins, or sort of low teens. But as time goes on, as they move through the investment cycle, we expect margins to move up there. And they've been a very cautious management team as well, which we like to see, cautious around what deals they do and preserving cash when the time is right, around the time of COVID with many other companies just, hanging back with dividends just to wait and see what happens. So that's been a very solid management team. So yes, another one that we have looked at very closely.
Yeah, I mean, I'll just highlight to investors, actually. I'm just getting back. I mean, Chemring's on a PE of around about 15 and Qinetiq's on around about 14, but they both make sort of 18, 19% EBITDA margins. So really high profitable, lots of IPR in there and barriers to entry, because you can't get a contract with the DoD unless they trust you, to say the least. Absolutely.
Yeah. And Qinetiq, very interestingly, they have a different type of agreement now with the US DoD compared to one they had in the past, which means that they can be much closer to the DoD. And they've made a very senior, that's been in the last year or so. And they've made a very senior hire there as well, a woman who comes from one of the US defense majors, which seems to have worked out well for them. I've yet to meet her, but I look forward to the day. So if she's watching this,
okay, we'll reach out. Absolutely, yeah.
Yeah.
And now one which has been around for quite some time is NCC, which is sort of like been bumping between £1.80 and £2.20 for probably the last 2 or 3 years, and it's still at that sort of level. It's got sort of two divisions. One of them is a software escrow that I think has had a bit of a sort of couple of headwinds over the last sort of like 6 months, 12 months. And then they've got the cybersecurity sort of like consultancy built business, which is actually still growing at double digits. Do you want to take us through this one? Because again, it's pretty cheap. It's trading on around about 15 times for a cybersecurity business. It seems pretty cheap to me.
Yeah, and I think, the incoming, the new CEO who's joined from the consultancy world, but his specialty was cybersecurity, would probably agree with you, that there's some value to be released there. I think the escrow business is digesting its reasonably recent acquisition of a US equivalent, Iron Mountain, but that is very much kind of utilities part of the business. That's very much necessary. Everybody needs to have that escrow service for their code to protect it and test it as well. And then you've got the more sort of exciting cybersecurity part of the business. And I think really for me, what might change for that part of the business, and it's something that's been, tricky for them and maybe for other technology businesses, and this is valid for Chemring and for Qinetiq as well, probably, is that, we are seeing news about some tech talent coming on the streets now, and that we've got a bit more availability probably of tech talent as some of the hyperscalers said staff and even, you know, some of the smaller technology companies, we are seeing that. So you've had in the past difficulty with hiring and retaining technology talent, maybe at some of the more mid-tier cybersecurity companies. And for companies like NCC, this may now be an opportunity to hire some new people or to, you know, to make it easier to retain their existing talent. So that is, you know, something that I see changing for them and maybe for other mid-tier technology companies.
Yeah, and this must be a really resilient sort of like, you know, B2B tech software type area, because the last any corporate CEO is going to cut is his cybersecurity, because he won't be in his job very long if he has a breach, and likewise the government, I guess, as well. Now, just switching gears into sort of financials, another one sort of like Paragon Banking, which does sort of like buy-to-let mortgages and sort of subprime loans. Now, this would be an area that I thought would be sort of like struggling, but I think that the credit quality of their loan book is still pretty good, actually.
Yeah, I mean, they have very low loan-to-value loans on their book. For want of a better expression, it's not their first rodeo, you know.
They've been through sort of like hoedowns before.
Yeah, I mean, they've got a strong balance sheet. They're buying back shares. I'm sure if you did a screen, you know, I think we saw of about the 50 holdings we have in our mid-cap investment trust. There are about 17 of them doing share buybacks now, and this is one of them. Yeah. You know, they have a very strong balance sheet. They have a prudent approach to provisioning. You know, when you compare them with some of the high street banks, actually, they are more prudent in terms of their stress tests as well. So that's good to see. And as you pointed out at the beginning, they were very much the buy-to-let, you know, very much focused on buy-to-let, but now they do the commercial lending as well. And their view, and I would tend to agree with them, is that the higher margins you get from that commercial lending and more than make up for the slightly higher risk profile that you get with it. So, you know, it's a blended book now, whereas in the past it was very much a buy-to-let story. You now have both angles, and you have a lower margin on the buy-to-let, but a higher margin on the commercial lending. So, you know, very experienced management team and solid balance sheet, and moving to a new, without getting too much into the detail of it, a new kind of IRB, which is an internally rated system whereby they can actually potentially give out more capital to shareholders as time goes on, once they fill in all the boxes that the regulators want them to fill in. But they have, you know, this long history and long data profile that other pretenders to it might struggle to compete with, or to, you know, to kind of disrupt that market would be difficult without the long history that Paragon or its ilk have got. So that kind of creates a moat for them.
Yeah, they can price the risk better, basically.
That's it.
I was just looking at them. I mean, their shares trade just slightly round about to the net tangible assets, just a bit higher sort of stuff. So if their credit quality is pretty good, that sort of underpins the valuations. Does that mean sort of like the loan growth, because in a higher interest world, there's likely to be less loan growth going forward, i.e. fewer people who want to be who can afford to borrow sort of stuff. But this stock doesn't have to work in a high low growth environment, does it? Because it's underpinned by its assets, I guess.
Yeah, I mean, I agree with you. You know, I think that is a question, isn't it, around loan growth more generally? That's the whole thing about, you know, back where we started. You know, it's all about confidence, isn't it, and animal spirits. And, you know, if you think that the UK actually, probably, if you look back to where we were at the end of September and in October, you know, things probably can't get much worse than they were then. You know, that we probably reached the bottom of a pit there.
You're tempting fate there, Jean.
Yeah, well,
but I would agree. I must admit, I hope you're right.
I think in this job it pays to, you know, you have to be an optimist, really. So, you know, with that caveat surrounding. But yeah, I think they're set fair. They're in a strong position. But, you know, we never know what's around the corner, clearly.
Yeah, true. Now, another stock which is very good actually for sort of like tail risk events is Man Group, the hedge fund.
Yeah.
Now this one's actually trading, and I can't believe it, at less than 10 times PE.
Yeah.
So, why is it so cheap for such a sort of high quality asset manager?
I think that, you know, some of it is to do with the performance fees they get, which have been pressurized. Not being, they don't get rewarded with a high multiple for those performance fees, because they're seen as not necessarily being repeatable. But I absolutely agree with you in terms of unexpected events. You would think they would be a winner, but they would tend to, the shares perform very well when they're seeing good inflows, and they had been seeing very good inflows. And then with the events around LDI, they saw some pressure. But what you'll notice is that they are buying back a huge amount of shares, and they've actually bought back 25% of their market cap over the last 9 years. So wow. That's something they do very much. And, I think what's interesting is with all of the data gathering they do, and the sort of billions of ticks of data they're gathering every day, if they think that the shares are good value, I would suggest that that's quite an interesting fact in itself.
Yeah.
And that's something they're doing very consistently, as well as paying a dividend. So generating plenty of cash internally and not issuing shares. And instead doing the opposite, buying back shares and paying dividends. So, I think a very interesting one to be sat in, and a point, one of these unique stocks doing something different to everyone else. Within the quoted universe, there aren't many others who use technology in the way that they do. So the person and the machine together. Luckily, they do say when you visit them, actually, we do think that the person with the machine gives you a better result. So they're not doing away with humans just yet.
Yeah. No, it isn't all algorithms anyway.
Apparently not. There's still some humans in the building the last time I looked.
But I must admit, I'd say a highlight to investors. I mean, this is a $3 billion market cap type business. And as I say, to trade at sort of like such a good level of valuation with that sort of like counter cyclical or counter volatility sort of play is probably a good sort of bit of extra ballast for people's portfolios, or certainly something to have a look at. Now, and also in the sort of the capital markets, got IG Group, which I think is a classic sort of like spread better to CFD. And again, I think it pays a really good dividend, and it's actually even cheaper. I think it's on about less than 9 times PE.
Yeah. I mean, with this one, I think the first thing people probably think about is regulatory risk.
Yes.
And you have that with the banks as well. Some of the mega cap banks. It's just, with them, it's, whether the government would impose a windfall tax potentially. But with these guys, it's clearly a regulation both here and in the US, the business they bought recently in the US. And currently it's payment for order flow and how much of that they would retain in the US. But they are very interestingly, following an acquisition they made in the US, they are a higher interest rates winner because they make a turn on the deposits of customers, and that's a new angle. Anyone who had looked at them 5 years ago might not be aware of that. But it's probably, maybe because of the regulatory risk, you don't know where that comes from now. And we spoke about the defense sector earlier, and that's, I think, it being accepted as potentially being able to be a force for good. So I think, you have to sort of bear in mind and accept that they are, they're doing a lot on customer education and so on, but the margins are, well north of 50%. They've invested a lot in technology recently. They've managed, the relationships with the regulator well. And so, you see very good growth there. And interestingly, today, we had some news from CMC Markets, which is to some extent working in a similar marketplace, not the same model in terms of some of the ways they run the business. But interestingly, I thought there, in terms of read across, they talked about seeing some good data in January in terms of people's willingness to get involved again. So, there may be some read across to IG there. And obviously, you clearly, companies differ, but when in trying to draw trends, you would pay attention to what CMC is saying and think there might be some commonality.
Yeah, animal spirits, isn't it? Brings people back into sort of investing. Now, another one which is not in sort of like the capital markets, but is in sports gambling, is 888.com, which I think has taken quite a bit of debt when it bought the international operations of William Hill. And it's always been a really well-known name in terms of sort of like, casino gambling and sports betting and stuff like that. And there's got obviously the US angle to it, but it does have a pretty high level of debt. Just more broadly, what sort of like level of debt do you sort of like, does the alarm bells start ringing on it? Because this is pretty elevated for such a large company, actually.
So looking out about sort of 3 years, you're looking at levels falling back to the kind of level that I would tend to normally be comfortable with. So looking at maybe 3 times, but I will agree the timing of the William Hill acquisition and some of the maybe consumer behavior around the last year has meant that their gearing is probably higher than we would ideally wish for. Having said that, I think when you look at the rationale for the deal, having high street stores, I think will turn out to have been part of the survivability of the model, because in terms of advertising, winning new customers, I think that having a store portfolio will be important. And one thing I noticed from their recent press release was that they're talking about stores doing 7% better revenues per store, those William Hill stores, than they were in 2019. So I think, obviously there are fewer stores, there are other rivals retrenching, and they've closed some stores themselves. So there'll be a bit of sort of reverse cannibalization, if you like. But that's what, that is a trend that is encouraging. And I think, again, looking out, you have to, I think, looking out over the next couple of years, you're seeing free cash flow yield forecasts up around 20-25% for this company. But I think there's no doubt that this is one of the more nervy ones. And if normally we would look at balance sheets geared, if they're de-gearing at about 1 turn a year, that's good. But looking at not encouraging it much past 2.5 times probably, and most at least half the holdings in the investment trust that I co-manage are net cash or have no debt at all. So I think if you have to look across the whole portfolio as well in terms of how you're geared overall. But it probably wouldn't be the place you'd want to start from immediately. I will say that 70% of the debt is fixed now, so that is a stronger position to be in for them. But I think in terms of structural growth, gaming is a sector where the UK, and I talked about the UK being better than the US in some areas. This is the birthplace of professional online gambling, and in terms of the rules being more loose here, and we just are much more steeped in the heritage of it here. So I think it's something that a US acquirer might also look at, and you've seen it with Playtech, you've seen it with some of the other UK gaming stocks that can really punch above their weight.
Yeah, and you rightly point out, I mean, this is a bit of an exceptional circumstance because gaming and William Hill has traditionally been hugely cash generative. And you're right, as long as things stay on the track, then that will come to comfortable levels of the debt. And I would point out to investors the valuation, which is, I guess, because of the sort of like the balance sheet elevated risk, is at least half of what, say, Flutter Entertainment is. So there's plenty of upside if they can keep the ball rolling, I guess. Just moving to the all things consumer. Again, another area that's been reasonably challenged, but you seem to have really gone to some excellent businesses. One of them, Dunelm, which again is sort of like really best in class soft furnishings for home. And I think they've had a bit of a winning Christmas as well with warm sort of like, furnishings and home stuff. Do you want to take us through this one? Because it's been a real winner for ages, actually.
Yeah, I have to admit, I was very encouraged when I saw the marketing coming through as the news about the energy bills going up was coming through. They were sending through emails with sort of hooded, fleecy blankets, plug-in things to keep you warm. And I think they really capitalized that, and that, they've always focused on the sort of cozy aspect. And I think, this is a stock that might not have given you a warm glow last year because, we talked about stocks being derated despite having no issues with earnings at all and doing what they said they were going to do. And I think this one was seen as a bit of a COVID winner. It's a bit of a one-off flash in the pan, stay-at-home winner. But, look at us, we're doing this on Zoom now, aren't we? And, there's still a lot of work happening from home, maybe not so much in the financial sector, but wear and tear on people's homes. And believe me, particularly in my home, I've got 2 young boys, and the cushion fights, all those traditional things. I think people are having to keep the spend up, and also it's a small, in terms of being recession booster, sort of a recession proof. Nothing is recession proof, but small average basket size is £30, and it's easy to give your home a little refresh in a cheaper way. And very interestingly, anecdote, a friend of mine is massively into interior design, and she keeps saying to me, oh, look, Dunelm do this great version of this thing for, 10 times cheaper than this other designer. And, they seem to have really managed to hire people who are good on merchandising and interiors, but also hired into the tech space as well. And they've transformed themselves from saying nobody buys soft furnishings online to actually we now do 35% of our sales online. And the pandemic really catapulted them into that. So, they've transformed themselves inside out. And they managed to do 70% of their overall sales with all the stores being shut through having a very strong website. So, I think that has been operationally excellent. And I think they call it operational grip, strong operational grip. And, that's been one that's reported fairly good numbers recently, again, so reinforcing.
Yeah, I mean, again, just the more anecdotal evidence. Actually, my wife and my stepmom, who are pretty discerning, canny sort of purchasers, just always go to Dunelm. Yeah. They absolutely love it because of the good quality and the value. So I'm sure it's chiming with a lot of other people. Now, another one which is doing well, which is Games Workshop, which again was sort of like was a bit of a winner during the lockdowns with its Warhammer sort of stuff and figurines. But it just struck a really interesting deal with Amazon. To do potentially to do a film and to do sort of like other TV productions on its Warhammer sort of like. Do you want to take us again? It's phenomenal to be able to attract that kind of caliber, sort of like over the top streaming giant.
Well, I probably would say this, but this is something that we've seen for a while. That there was IP waiting to be monetized. So it was a case of when, not if. But we saw the Amazon news come through. We saw Henry Cavill mention Warhammer on a chat show maybe 3 or 4 months ago, and then his name being associated with them. So it's probably important to be clear, so I don't get into trouble with them, is that it's an agreement in principle so far. So the details are still to be thrashed out, and it's for TV series and animation. Just looking at the language that they used. And when you think about it, it could be, up there with something like Marvel, the number of characters that they have that they could build out that have personalities. This is a company where, you can paint different figurines, eyeballs in 5 different colors, the variations that they have and the amount of material they could generate from the characters they have and a huge back catalogue. So yeah, very, very exciting. Details still to be decided, but I think it just shows that they were able to have Amazon. I'm sure they weren't the only ones who approached them, and I don't know that, but I imagine they were being looked at, admired from afar by quite a number of content creators. So with this huge, you do say, how do you monetize this catalogue of IP? And this seems to be very much the way to do it. And you still have the growth to come from markets like China and the US for them, where they're only just beginning. And the hobby here in schools, I see, in many secondary schools, they have Warhammer clubs. And, it's very much an institution in the UK. And I think, that can happen elsewhere. And, the animation and the TV series can only serve to push that forward in other markets, in my opinion.
Yeah, no, I would agree. And Amazon, I think they spent $1 billion just on the Lord of the Rings 6-part series that they previously, or the Power of the Rings, they called it. And when you put that against the context of a £3 billion market cap, it's pretty good licensing fees. Maybe we'll wait and see anyway. But you're right.
Let's not run ahead of ourselves.
Yeah, the deal hasn't been struck yet. Now, what which used to be a sort of like a real darling, and then sort of fell on tougher drums. Is PZ Cussons, which is sort of like that, the classic sort of like soap, imperial leather, but also Carex, I think it is, and other types of sort of like personal cleaning. And they've got a big business out, obviously, in Nigeria, etc. Right. But they seem to be on. What's your latest on PZ Cussons? Because I know a lot of investors really like this business, but it's just to say fall on some tough ground.
Yeah, I mean they had not so new now, but CEO came in about 18 months, 2 years ago, who was very much focusing on their key brands, you know, having seen that they were maybe spreading themselves a little bit too thinly. And I think they're demonstrating some success now in growing those focus brands. They had a bit of noise again, you know, COVID sort of skewed a lot of trends. So obviously Carex saw a huge increase in purchases, and also a bit of fake tan, but only from the neck up, for obvious reasons. in their fake tan brands. But you know, I think there was, you know, quite a lot of internal self-help that can be done. You know, I think in terms of waiting for news, and I think news on what happens next with Nigeria would probably be welcomed by the market. But you know, it feels like the new management team or newish management team have ideas on how to improve things, and they are bearing fruit now. And you know, there are several very strong brands there that can be revived. And are in the process of being revived. I mean, certainly there's Imperial Leather hanging around in where I've come from, always, you know, as a staple. So I think, you know, there's a lot of heritage there with it as well. So it's, you know, just a business that can be unlocked. And you know, it's one of those defensive purchases as well, you know, for when, you know, people want their brands. So yeah, I think that management team have proven themselves to be making a difference already.
Yeah, and you'd have thought, I mean, you know, I mean, who knows, it's all hypothetical, but you know, one of the big consumer personal products groups, your P&Gs, your sort of like Reckitt Benckises or a Unilever, something like that. I mean, they've PZ Cussons seem to make 10% EBIT margins compared to the big FMCG giants, which is 15 to 20. So there must be, if you scale it properly, there must be certain lots of cost synergies, plus there'd be the marketing synergies by taking the products further afield than just sort of like, you know, the normally developed markets and into other sort of emerging markets. But hey, that's just another hypothetical sort of like thought. Now moving to industrials and chemicals, Bodycote, which does sort of treatment for sort of hardening materials. And I think it sort of like does lots of the big sort of, you know, different industries, defense, aerospace, energy and auto and stuff like that. And again, it's trading at a sort of mid-teens. You want to take us through this one? Because
I think this is an interesting one. You know, it was very beaten down, seen as being very exposed to automotive and sort of being written off as automotive was under pressure. But in November, they said that civil aerospace volumes were continuing to grow strongly. And I think that was a real vote of confidence for that part of their business. And so what they do is they high pressure different parts that go into engines, you know, things that you can't afford that to have air bubbles in them. So it's absolutely crucial what they do. And, you know, they also talked about passing costs through. There was some uncertainty around whether they would be able to pass their not insignificant energy costs through. And they also said that their approach to using, I'm quoting it now, to using surcharges to cover the highly volatile gas and electricity prices has proven to be successful. So they're talking about strong growth in aerospace and their strategy to use surcharges being successful. So that kind of tells you something about their pricing power, I think, you know, that they're able to pass these costs through. And there might have been a question around that before. And of course, during COVID, that management team took the initiative to slim down operations and make things more efficient. So I think they're reaping the rewards of some of that now. And, you know, they appear to be in a good place, and it was a reassuring statement, but we won't hear from them, I think, until March now. But, you know, one of those ones where there may have been a lot of fear, but we know where some of their markets, they're also exposed to defense as well. So, you know, some of their markets have been surprisingly resilient or on a turn.
Yeah, commercial aerospace is definitely coming back really strongly now. No, just look at the Airbus and Boeing, what they're saying in terms of plane deliveries. Now another one, Synthomer, which I think is it's sort of like an adhesive sort of type business, but it's adhesive business. Yeah, it's adhesives and coatings business, and I think it's great. Okay, yeah, that's right. It's got quite a bit of sort of like debt, but it's just sold one of its divisions, hasn't it? Laminates in the fabrics, I think. Do you want to take us through this one? Because again, you'd optically wise, you'd say, well, it's got a sort of like a balance sheet needs a bit of repair, but again, it's on a really cheap valuation, sort of 7-8 times PE.
Yeah, well, you had this is a company that did a number of acquisitions, you know, and got to a point where it was probably had a bit more gearing that it wanted to have. You had a new CEO and a new finance director coming in, and they needed to show the market that they would be able to do a disposal in order to shore up the balance sheet. And they succeeded in doing that in December, and they announced that in December. But they were also one of these companies that had benefited from a sort of a COVID bounce, shall we say, in terms of their sales of rubber gloves and rubber nitrile gloves, so that they provide the material that goes into those gloves, which were being used hugely during the pandemic. And then they ran into a glut where companies had overstocked, and now there's destocking going on in that market. So you kind of have to get over that that hump in the trading, and meanwhile you're under a bit of pressure on the balance sheet. So the announcement of the disposal, which of a non-core business, was very welcomed by the market. And you can expect to see businesses like their coatings starting to benefit now. We are seeing some stronger industrial data, so particularly in the US. So I think, you know, for them, you might see some parts of the business begin to turn. But where you really see, and what the market really wants to see there, is the destocking coming to an end on the gloves, because that could turn things around very quickly. But that, you know, generated hundreds of millions of additional cash during COVID times, which then could be spent on acquisitions. So it's you know, it's you know, the market gave and the market took away with that.
Yeah, as long as you spend your money wisely, I guess. Now, the final one on the sort of the chemicals and the industrials is Victrex, which is it's the sort of high performance thermoplastic PEEK, which I think was invented by ICI back in the sort of late 1970s, I think it is. But it's used now for sort of like in medical sort of parts, isn't it? I actually just see that, you know, for putting it into patients. Do you want to take us through this one? Because again, it seems as though it's a bit of got lots of IPR actually.
It does. I mean, it's used to replace parts of people's spines, interestingly, but also used in industrial applications. And it's the substance they make is called polyether ketone.
Oh, okay, well pronounced.
Chemistry aficionado colleagues tell me. And it's strong enough to hold up the wings of a plane.
Oh wow!
And what the really interesting thing about this substance is it can replace metal. And so and when it replaces that metal, it makes the craft lighter, and therefore the craft will emit less carbon, use less fuel. So there's an advantage for the environment as well. And they also, very excitingly, on the medical side, which is the very high margin side for them, they can charge more for that. They are being used in knee trials as well. If you've got any friends, or I'm sure you don't have a knee replacement, but those metal replacement knees are very, very heavy, and they're now participating in a trial whereby their knees are being tested by certain surgeons. And once you get that adopted by a surgeon, and they start using it, you know, especially the sort of more high profile surgeons, that could be a game changer for them as well. And that's one of their, what they call mega programs, which are, you know, new products that they're looking to move into the market with. And another one is flexible pipes under the sea to transport oil and gas. That's another one of their mega programs. So they have various aspects of avenues of growth that could grow to be very big products for them in the future, as well as the sort of bread and butter of what they do every day. Materials used in phone casings, for example. So yeah, a very high margin business, and you know, probably one of the jewels in the UK's industrial crown.
Yeah, I think Annie's got a rock solid balance sheet as well. So that's certainly, I want to have a good look at that one. Now, just finally, on some others ones, we've got Keller, which is basically a geotechnic business that should be benefiting, obviously, from a lot of the infrastructure spend on both sides of the Atlantic. And then it came out with a sort of surprising that it found a sort of fraud in Australia that sort of knocked its shares and said, just two things. One, to take us through what you said you've got feelings on Keller, but more broadly, when a company sort of like brings out a bit of a shock, how do you sort of like assess that in terms of whether you sort of like you lighten up your position or whether you sort of buy more?
So we are very fortunate here in that we get to speak to management very quickly after any announcement like that, usually within a couple of hours.
Oh, okay.
And what was interesting about that headline is it was all run. It said something about accounting fraud and trading update. And it looked like it was an update on something that you should have known already, which of course it wasn't. But so there was good news and bad news. Yeah. Trading better than expected. The amount of the fraud was reasonably low relative, and actually that needed to be stripped out. It was single-digit millions. And actually the trading better than expected made up for the amount that would need to be stripped out because of the fraud. So and it was also in a business unit that was very separate from the others. So it wasn't a central part of what they do. It was a part of the business that was doing things a bit differently to others. And I think it'd be fair to say, probably it was in Australia, it would be fair to say that had management been able to travel a bit more freely over the last 2 or 3 years, things might have been different. But that's, as we said, you never know what's coming the next day. But you started from a point where valuation was not stretched. Had that been a stock on 45 times earnings, but it's, this is a company that's been growing revenues strongly, that's yielding very good dividend, and has strengthened the balance sheet considerably relative to its own history. So it's coming from a position of strength in terms of valuation and its own balance sheet and the core business and the way it's trading. But of course, you have close conversations with the company after something like that happens, and it tests everybody's mettle, I think.
Yeah, I mean, I think the big question is it a read across for the rest of the group? Is the controls lax? And it sounds though that sounds as though, because they couldn't actually go and see it and it was an isolated division, then it was unfortunate that it was a potential, should be the one-off. But I must admit, the valuation, even it's £8 and it's less than 8 times PE on a good solid balance sheet. So looks plenty of upside. Now, one which is sort of like done really well actually is 4imprint, which is mainly a US business, sort of promotional sort of like products, I think, sell to B2B side. And I'm guessing, I don't know what's been boosting all the growth here. Is it sort of like managers giving their staff some sort of like freebies, and what is it?
It's baseball hats with Schroders on the front of them.
Oh, is it? Oh, okay. Well, you've done really well for you. Yeah,
I mean, this is one that really suffered during COVID and, fell to a loss at one point, which, for 1.5 years, which I never thought I'd see with this, and has had an unbelievable recovery, 2 years in a row of above 40% growth. And, the update they had last year upgraded their earnings from their revenue line from 40 to 45% growth. And this was, I think, the 3rd or 4th upgrade in a row. And they also talked about a net cash balance of 87 million. So this is just a great bounce back, but also talking about marketing and much more efficient marketing spend, which has really pushed up their margins. So profits growing by even more than revenues. So I think this is another, very much success story, which is, a UK stock, but not generating most of its revenues. In fact, generating 98% of its revenues outside the UK.
Yeah, and another world another world-class business, Diploma, which I've been looking at for years, but it's never been cheap enough on my sort of radar. But it's sort of like a distributor of sort of like technical parts to sort of like life sciences and seals and controls like that. But I guess these are really quite niche consumables, and therefore it allows them to get really good, 18-19% EBIT margins.
Yes. Yeah. So, I mean, Diploma is one that, became expensive, derated, but has come back with a number of upgrades, reassuring statements, and, is, as you said, in 3 areas where it's exposed to more the OPEX cycle than the CAPEX cycle, which is good and bad because in terms of visibility that you can get, but it's, I think, well hedged in that it has, for example, the medical division, which was under pressure when procedures couldn't be carried out, which is now coming back, and that's very high margin. So it's a bit, it has a number of levers it can pull. And it has, as you said, very high, is able to generate very high margins, has done a very good deal in the last 2 years called Windy City Wires, which is plugged into the telecoms revolution, and having the right wire for that is key, because you don't want, messy wires all over the place, and having them coiled in the right way and organized in the right way, the right colors, far more complicated than you would think. And that is that was a very successful acquisition for them recently. So what they do is they make they make bolt-on acquisitions mostly. That was a slightly bigger one for them. And then they integrate them. And they tend to, make a success of these businesses that they acquire. So it's sort of a serial roll-up story that has been successful over a long period.
Brilliant. Well, yeah. Well, thanks very much for your
Sure.
for your insight. But great selection for investors to have a look at in terms of growth, and we've got value, good dividend players, and sort of like real sort of like financial balance for the portfolio. And just sort of like finally, if investors want to put their money into the sort of the investment trust or into other Schroders' other funds, how best to do it? Yeah, Jean.
Well, Schroder UK Midcap is a publicly quoted company.
Oh, okay.
The ticker is SCPLN. And then there's, through the usual Schroder sales channels to go into more of the open-ended fund side things. We have Schroder, the mid 250 fund, which is a unit trust as well. And then within the team, we run some small cap strategies also. But the mid cap funds are very much focused on that mid 250 index, which is the FTSE 250 excluding investment trusts.
Yeah, well, as I say, I think with the valuation of UK mid caps being sort of like extremely attractive levels, then the long-term future seems to be pretty good. So thanks again, Jean, and look forward in touching base in about 6 months' time.
Great stuff. Thank you.
Thank you.